Welcome, dear traders. Last week, Wall Street saw a meteoric rise following the release of the inflation report. The CPI indicator exceeded economists' forecasts. The core inflation slightly declined. It was the first drop after reaching high levels in September. Investors were overjoyed. They began to factor in smaller rate increases. They were betting that the Fed may hike the interest rate by less than 75 basis points in December. Currently, speculators are pricing in a 50 basis points rate hike at the start of December. The US will release a crucial labor market report, which could provide more hints about the Fed's future moves. Nevertheless, market participants will be more focused on the CPI figures for November and December. Now the question is whether stocks will be able to maintain a bull run that started last week. The further upward movement will depend on a new batch of macro stats and signals from the Fed. Wall Street may begin a corrective decline as euphoria is fading and traders are now more realistic about the market situation. Besides, their expectations were in vain. There have been no drastic changes in the Fed stance. The central bank remains strongly committed to aggressive tightening at least until the middle of next year. This is rather bearish factor for stocks. This week is going to be quite eventful. The US will reveal the retail sales report, the producer price index, and the housing sector data. Investors will also take notice of earnings reports of big retailers such as Walmart, Home Depot, Target, Lowe's, and Macy's. Watch our video review and leave your comments down below. Let's start. Apart from inflation data, the US midterm election was also in the spotlight. Although this event did not significantly affect markets, it did trigger a surge in volatility. Wall Street ended that day in the red. The Democrats failed to keep control of both chambers. However, it's hardly surprising. Historically, such a scenario has occurred quite often since the Second World War. In the middle of the presidential term, the leading party loses seats in the House of Representatives in the midterm elections. Analysts had expected such a turn of events this time as well, and it happened. The Republicans also did not achieve what they wanted. The party is likely to take control of the House of Representatives, which could be negative for risk assets. The split between the government and the Congress could take place next year when discussions about the debt ceiling will flare up again. Yet last week, the main driving force for the CPI report. Investors reacted more sharply to this report than to other events. Before the release of inflation figures, futures for the S&P 500 grew by 0.3% and then added more than 5%. Such rapid growth could have also been triggered by the fact that traders rushed to close short positions. After Thursday's robust rise, Friday was less positive. Nevertheless, Wall Street once again ended the week with gains. The latest University of Michigan survey showed that consumer sentiment reached its lowest level in 4 months. Investors were taken aback by new dramas in the crypto market, namely the bankruptcy of exchanges. Digital currencies took a nosedive, dragging down other risk assets. Despite the relatively upbeat inflation figures, which improved sentiment on Wall Street, the risk appetite seems to be gradually declining. On Monday, stocks slid into negative territory. The equity market dipped following Fed policymakers' hawkish comments. Fed Governor Christopher Waller warned investors against being too optimistic about one inflation report. The market seems to have gotten way out in front on this over this one CPI report. Waller pointed out everybody should just take a deep breath and calm down. We've got a ways to go. However, the Fed official admitted that the regulator could consider smaller rate hikes at the next meetings. Waller said that markets should pay attention to the end point of rate increases, not the pace of each move. He also stressed that the end point is likely still a ways off. All three benchmark stock indexes are still hovering at the highs, although there is a risk of a deeper correction. The Dow Jones rose by 0.1% on Friday and gained 4% over the week. Its main driver was the news that China eased some of its strict COVID rules. As a result, US-listed China stocks and commodities jumped. The Dow and the NASDAQ notched the most impressive increase. They had finally broken through a strong resistance level or a descending trend line, which did not allow the indexes to move higher for a long time. Now they need to consolidate above the descending trend line to cement further upward movement. As traders primarily focused on inflation data, they ignored other important events. Many investors have forgotten about Jerome Powell's comments that the Fed is closely monitoring the Treasury yield curve. The recession in the United States is no longer technical. The US 3-month bond yield approached multi-year highs. For this reason, a further decline in inflation looks likely as the economy is experiencing a severe downturn. Although the labor market remains resilient, the latest reports also indicated an economic slowdown. This week, fresh data on sales and construction of new homes is on tap. These reports may provide more information about the state of the labor market and the economy. Apparently, stocks have started to rally despite the signs of a recession. Investors are paying zero attention to it, being over the moon after a decrease in inflation. They are now buying up risk assets at cheaper prices. Sooner or later, they will have to come down to reality. It remains to be seen what reaction could follow. Judging by a more distant outlook, the situation is not so dismal. Goldman Sachs predicts a beyond rise in risk assets next year, which may total 17%. The bank made such a forecast taking into account the movement of risk assets during the US presidential election cycle. Morgan Stanley also expects the stock market to grow by the end of the year. Thus, one should buy oversold assets, but at the same time keep a cool head. The S&P index also showed a positive dynamic. On a Friday, it climbed by 1%. Its weekly gain totaled 6%, the strongest indicator since June. The index is likely to break above the 4,000 level. The next target levels are located at 4,080 and 4,110 points. Apart from economic reports, the earnings season is also in the limelight. Although inflation data overshadowed quarterly reports released last week, market participants are sure to closely follow revenue results and the forecast of American companies. For the S&P, the third quarter earnings season turned out to be better than expected. The quarterly results of many companies topped forecasts. However, the vaguer future outlook is likely to exert pressure on stocks. Earnings forecast for the S&P and the NASDAQ for 2023 are worsening. Now the S&P and the NASDAQ are fairly valued, as their shares are not cheap and not expensive. However, in this case, the upside potential is quite limited. It appears that the stock market is overvalued. This is why stocks may lack drivers for further growth in the near future. The S&P index may even slide into the sideways channel. The target level is located at 4,000 points, yet the index will hardly move higher. As the revenue forecasts continue to decline and there is a risk of a slowdown in the economy, the S&P may decrease from the current highs next year. If the regulator does not shift to a softer stance, the market will remain in the sideways range of 3,300 and 4,000 points until a strong catalyst for a rally appears. Investors need to be sure that the earnings forecast will improve, otherwise there will be no steady rally. The heavy-tech NASDAQ 100 was the biggest gainer among other stock indexes last week. It advanced by 1.9% last Friday, adding almost 9% and logging the best weekly performance in 2 years. Tech stocks took advantage of a sharp decline in the US government bond yields. However, still a rise may end as quickly as it began. On a Monday, the NASDAQ dropped the most compared to other indexes. Its decline exceeded 1%. In the coming sessions, traders will also pay attention to the comments of Fed policymakers. Their rhetoric is highly likely to remain hawkish. Investors are already anticipating such a scenario. On Sunday, one of the Fed governors who wrote on interest rates made it clear that traders should not be overly excited about a small drop in consumer prices. Other policymakers could also express their commitment to aggressive tightening. However, the tone of their remarks may be less hawkish. Traders are now factoring in a 50 basis point rate increase at the December meeting. The benchmark rate will probably be in the range of 4.75 and 5% next year. However, everything may change after the release of the Consumer Price Index for December, so it's better to stay alert and be ready for different developments of events. This week, Tesla shares sank by 3.4%. Tesla CEO Elon Musk referred to high employment when he was asked about electric car deliveries and the recent acquisition of Twitter. Perhaps investors considered his refusal to comment on the situation as an unwillingness to voice problems the company could be facing now. Russia's stock tumbled to a 7-week low. Russia's Alzheimer's did not slow dementia progression in the 2 trials. Credit Suisse analysts who had seen a 20% chance of the drug reaching peak annual sales of $10 billion called the trial failure unequivocal. The shares of other companies working on Alzheimer's drugs went up. Biogen stock jumped by 3.8%. Traders are now largely focused on earnings reports of top retailers such as Walmart, Home Depot, Target, Lowe's, and Macy's. Their revenue results will show how American consumers are coping with the soaring prices caused by inflation and rate hikes. And that's all for now. Subscribe to our channel and stay up to date with the latest market news. See you soon.